Hey guys, today we're going to be going over National Bank of Canada, and we're going to kind of be talking about if this is one of the best Canadian banks that are positioned when you're comparing it to the other Canadian banks. So if you guys are unaware, the other big players within the Canadian banks is, for example, TD, which is the Toronto Dominion Bank, and Royal Bank of Canada. There's also RBC, Scotiabank, and CIBC as well, which are big players within the Canadian banks. And National Bank is considered about the sixth largest bank in Canada. But we're going to be talking about on why it's the best Canadian bank in Canada. Okay, so today we'll be going over, start with the business overview and just some important things that are going on, some notable things to consider, what to follow, where a lot of the revenues are coming from, and the bottom line, what is really driving their profitability. So to the left, you can kind of look at the key statistics while I'm going over the recent news if you would like. So on November 3rd, they announced Q4 are released, or the Q4 earnings are going to be released on December 2nd, 2020. And they beat earnings. You can kind of see if you look back at all of the other Canadian banks at the time, because they all report their earnings around the same time. They all went up in price, which a lot of all the Canadian banks, the entire industry beat earnings. They did better than expected, which is great to note. On November 9th, they kind of gave a lot of ESG updates. Some examples of this is that they want to reduce their greenhouse gas emissions by 25% by 2025 and reduction in pulp and paper consumptions. They want energy savings, light fixtures within their branches, um, which is all really great to consider because one of the huge trends that's going on right now with a lot of the younger investors is that people want to invest in companies that are ESG friendly. And the credit rate or not credit agencies, but agencies give out ESG ratings, and based on these ratings, it can determine if fund managers are going to invest in a lot of companies. So companies are trying to push and show that hey, we're ESG friendly, we're doing this, we're reducing our greenhouse gas emissions. So to see that National Bank is following this trend will be good, as if they get a good ESG rating, it could help with money inflow as well. Another notable trend that's going on within the banking sector, specifically in Canada, is that with the Robinhood app and zero trading commissions, they're just lowered their margin interest rates. There's a huge downward pressure on these management and trailing commissions and all these fees that Canadian banks are getting towards their the stock market and a lot of trading and stuff like that. So it's the second time within the Q4 period that they've reduced their management and trailing commissions fees by 0.25%, which is showing that there is really this downward pressure that people want lower fees. Some things that are important to consider when you're kind of following any Canadian bank right now, specifically with this time we're in, you want to follow the amount of cases that there are. So when you kind of compare it to Quebec and all the other provinces right now, Quebec is about 20% of Canada's population, and it has about a little over 35% of cases. So it's really important to consider when you look at the geographical breakdown. A lot of the revenues is coming from Quebec. So the Quebec economy shuts down again. National Bank of Canada has a lot more idiosyncratic risk associated with it than a lot of the other Canadian banks that you can consider if that's important for you or not. But that's just one of the facts that I'd like to identify. Another thing that's really important is PCLs, which stands for provisions for credit losses. What you need to do to follow this is look at a lot of the macroeconomic indicators and guidance that management is giving. So, for example, National Bank of Canada has announced that their PCLs are kind of determined through a lot of mortgage, the housing market, the oil prices, unemployment rate, and things like this, right? So if these macroeconomic indicators get worse, National Bank of Canada is going to expect higher PCLs, which is a direct write-off through their net income, which will really hurt their profitability. So you want to follow how the overall macroeconomic environment is going, and this will give you an idea on if their PCL should increase or decrease. And then the last thing is interest rates. So look at the Bank of Canada. They have announced that they're expecting until 2023 they're going to keep the bank rate at 0.25%, which is it makes it a little harder for banks to create that net interest margin spread, as we all know they make money through what they pay us in our deposits. So what you put into the bank, they may pay you, let's just say 0.25%. They use your money to put out loans within mortgages. let's say they get 3%, the interest spread is 2.75%. That's what they make. So if they're paying, the Bank of Canada is keeping these interest rates lower, it's just going to hurt their profitability. It's a little narrower of a spread that they can get. So when we go back to a geographical breakdown, 55% of their revenue is coming from Quebec, 19% from the rest of Canada through all the other provinces, and 26% coming through their international operations, which is basically a bank that they have in Cambodia that's doing exceptionally well. About 30% growth. It's doing insane right now. The Cambodian economy is growing at a GDP rate of about 5%. And when you compare it to Canada, we have like 1 to 2%, 1.5 to 2.5%, so the Cambodian economy is doing great. And they also have a subsidiary called Credigy, where they own an 80% stake in, that basically buys distressed assets of companies. So if a company wants to buy accounts receivable or sell off some accounts receivable, they may discount them and sell it to Credigy, and Credigy will collect these accounts receivable and try and make a profit. Or if a company wants to sell off some mortgage loans or anything really like this, they kind of go to Credigy. And when you're looking at the net income breakdown, National Bank of Canada has four main business segments, which is P&C, wealth management, financial markets, and international. P&C is personal and commercial. It's the main driver in their profitability. As you can see, it generates the highest amount of net income for them. So for this is where they give out a lot of their mortgage loans and loans to businesses, their everyday banking, lines of credit, credit card activities. So a lot of those things. When you look at wealth management, a lot of their fees is coming through, a lot of their income is coming through trading activities. So if you have an account with them and you want to buy a stock, let's say in the stock market, and you pay $10 for the trade, well, that's in the wealth management segment. Also financial markets, which is where a lot of investment banking and corporate banking activities are. So it's similar to like JP Morgan, Goldman Sachs, what they kind of do. So if Apple wants to issue debt, issue new equity, get a fairness evaluation, their National Bank of Canada has that business segment where they can help these investment banking activities with. And then international, we went over that with their bank in Cambodia, that's doing really well, and Credigy, that's doing okay within the United States. So we're going to go over kind of the investment thesis and our football field chart of valuations. So what allows National Bank of Canada to be the best bank within the Canadian economy is that they have a leading market position in Quebec. So they have majority of market share in Quebec, and Quebec does better than every other province as far as macroeconomic indicators. So Quebec economy is doing better than every other province. National Bank has majority market share. National Bank does better than every other Canadian bank. And you can see this through their price chart. If you look at the past 10 years, they outperform, dividend adjusted, every other bank. Also diversified income and lending activities. They have they're exposed to emerging markets, and they're exposed to the United States, and they're have exposure within every province of Canada. And if you look at their loan book, one of the things to consider within Canada is there's a huge oil and gas part within Alberta. It's not doing the best right now. When you kind of look at their exposure in their loan book, they're not that exposed, and to what they do have, it's all secured, so there's less risk of any actual defaults that will really hurt their net income. And when you look at strong capital and liquidity positions, there are ratios that the Ontario Financial Superintendent, the Office of Superintendent of Financial Institutions, called OFSI, has. So the Common Equity Tier ratio is one example of this, and they're far beyond what their capital requirement is supposed to be, so they can withstand any stress tests. And we kind of move on to our football field chart. We're looking at multiples of price to book value and forward-looking price to earnings, which is really important within financial sector. As we kind of if anyone knows what a DCF is made, we kind of look at a DDM model, dividend discount model, because with the bank, their assets are created through liabilities, so it doesn't make sense to do a DCF. So you use a DDM. So we have these weightings, 50% DDM, 50% in the multiples, and we have a target price of $74.15. They're currently a little above $71, so there is a bit of an upside. And just to break down the investment thesis a little more, leading market position in Quebec. They've accelerated reopening within the Quebec economy, within all of the infections that may be had. And within the province of Quebec, it's outperforming any other provinces in Ontario, which is helping. And then they also have the below average debt. The Canadian residents have below average debt balances than any other provinces, which is good for the Quebec economy, as if the National Bank gives out loans, there's a less chance of these people defaulting, which is good. And go over diversified income and lending, the growth against all business segments. If you kind of go back to the chart I showed on the first slide, you can see comparing it 2019 to 2020. Diversified loan book and retail, we talked about this with oil and gas industry and their exposure to emerging markets and above industry profitability. National Bank is the highest return on equity within any other Canadian bank. Strong capital and liquidity positions. Again, we talked about common equity tier 1 ratio. They also have liquidity coverage ratio, which is about 50% above regulatory minimum, so they can withstand these financial stress tests. So we're looking at the comparable company analysis again, looking at two of these valuation techniques. So forward-looking price to earnings, price to book value. On the forward-looking price to earnings, they're below the peer medium of 12.6, which is implying an upside of about 5.5%, showing a share price of about a little under $76. And they're a little rich valuation with price to book value with a peer median of 1.3 times, which is implying a share price of $51 and a downside of about 29%. But what's really important to consider with National Bank of Canada is because they have the highest return on equity, investors may think this is a fair valuation, as their management has proven within the past decade that they can consistently get these high return on equities and generates these returns within the assets that they're given. So just keep that in mind. Again, we're going to go over some risks now. What's risky with National Bank? Well, one, with infections. The Quebec economy, they have more infections that they are in the percentage of the population. 35% of cases in Canada, about a little over 20% of the population. If this really hurts the Quebec economy, if they need to shut down, because National Bank is so reliant on the Quebec economy, they have an idiosyncratic risk that no other Canadian bank has. So that's something to consider with how the Quebec economy does and how this will help with National Bank. Again, low interest rate environment. Bank of Canada isn't considering raising interest rates until 2023, so it's going to keep these interest rate spreads low. It makes it a little harder for all Canadian banks. This isn't just National Bank to create this net income with their net interest rate margin spread. And again, their weak presence outside of Quebec, as they're just so reliant on the Quebec economy. If the Quebec economy does bad, it's not going to look good for National Bank. I'm just going to go over again just to remind yourself, having a buy recommendation, as we have an implied upside. It could also be a hold recommendation. Kind of just consider this for yourself in your own portfolio if you think this is a cool buy or not. Just you can go over the investment thesis. They have a leading market position in Quebec. Quebec does better than any other province. National Bank does better than any other bank. Diversified in their income and lending, and they can withstand any stress tests that can come through their way with their common equity tier 1 ratio and their other ratio that's well above the requirement. So we put a weighting of 50% on the DDM, 50% on multiples, have an implied share price of about $74.15. The current price as of recording this is $71.79, which is implying an upside of about 3.3%. So that's it. Thank you all for listening. If you have any questions, I'll be happy to respond.